Session 3A on culture of equity and long-term investment by households. This session will be chaired by Rachana Baid, and we have Jainendra as the discussant. Now, I would like to take the opportunity to introduce our chair and discussant. Dr. Rachana Baid is an MCOM gold medalist and PhD from Osmania University, Hyderabad. She is a faculty at NISM since inception. Prior to NISM, she has worked in UTI's Indian Institute of Capital Market. She has conducted a number of training programs and research assignments for marketing participants, civil servants, and international delegation, including Asian countries. Her areas of interest are financial institution and markets, portfolio management, corporate finance, and behavioral finance. She has also been a visiting faculty at ex-ante Jamshedpur and SPGM Global School of Global Management, Mumbai, Dubai, and Singapore centers for over a decade. Jainendra Shandilya is currently working as Assistant General Manager in the Market Regulation Department of Securities and Exchange Board of India. He joined SEBI as manager in 2001 and has worked in various departments within SEBI, including investigation, enforcement, inquiry and adjudication, communication, and the Office of Central Public Information Officer. Previously, he was a faculty member at the National Institute of Securities Market, where he taught fixed income and derivatives. At National Institute, he was also a program director of postgraduate diploma of quantitative finance, postgraduate diploma in data science, and postgraduate diploma in financial engineering and risk management. Jainendra has over 20 years of experience in banking and securities markets, and he has published various articles on securities market, which have been carried out by various newspapers, magazines, and journals in India. He has been a guest speaker at many colleges in Mumbai and at various national and international seminars on matters related to finance and capital markets. Before we begin the session, let us go over the guidelines. A total of 15 minutes will be allotted for paper presentation, upon completion of which a bell will be rung. Post this, 2 minutes will be allocated for presenters to conclude. This will be followed by 7 to 8 minutes of discussant remarks and an additional 5 minutes for Q&A. I will now request our Honorable Chair, Rachana Baid, to take the session forward.
Thank you so much, Ankita. I request the first paper presentators, Jains Chacko and Lakshmi Padmakumari, to make the presentation. They would be presenting on just investor-based effective firm level ex-ante cost of equity capital.
The title of the paper is Does Investor-Based Affect the Firm Level Ex-ante Cost of Equity Capital? I am Jains Chacko. I am a PhD student at Arunima University. The paper is covered by Dr. Lakshmi Padmakumari, Assistant Professor at Arunima University. Moving on to the outline of the presentation: introduction, followed by review of literature, hypothesis, data methodology, results, and findings. Moving on to the introduction, investor base basically refers to the number of common equity shareholders of a public limited company. In the landmark paper, Merton 1987 states that managers do have the incentive to increase investor base mainly because of its effect on the market value. So this effect is intuitively appealing when we consider the agency problems associated with concentrated ownership. According to the theoretical proposition of Jains in 1976, increased ownership concentration increases the manager's incentive to take benefits at the expense of outside shareholders. However, this effect varies according to the country setting and nature of agency cost. In India, studies found that there is ownership concentration in firms. So even when there is ownership concentration, the manager's concerns over firm reputation, growth, and market survival reduces the agency confidence. Reduce the agency conflict, reduces the expected return, and reduce the expected returns increases the firm's market value. In such a scenario, we expect that a dispersed ownership structure of Indian firms reduces the incentive of small owners to monitor the managers, and that increases the agency conflict. Increased agency conflicts increases the expected returns. So our study examines the effect of investor based on ex-ante cost of equity capital. Ex-ante cost of equity capital is formally known as implied cost of equity capital, which is the cost of capital that is implied in the current market value of equity and future earnings forecast. We adopt an implied cost of equity capital approach because studies found that implied cost of equity capital serves as a better measure of expected returns, and also it precisely captures the variation in firm's market value. And another way to look at the implied cost of equity capital is that it is the internal rate of return that equates the current market value of equity with the present value of future expected cash flows. Moving on to the literature review. Studies found that there is a positive relationship between investor base and firm's market value. This relationship can also be inferred from the investor recognition hypothesis of Merton 1987. According to the hypothesis, when investors choose not to invest in stocks that are not very familiar, the market for such securities narrows and the expected return increases. Increased expected returns reduces the firm's market value. Subsequent studies also found evidence favoring investor recognition increasing firm's market value. In contrast to the direct relationship, studies also reported an inverse relationship due to increased agency conflict associated with the dispersed ownership structure. When the ownership is dispersed among a large number of small investors, it decreases the firm's market value because of increased agency conflicts. Linz and Warner 2004 found that investor base is the channel through which the weakness of corporate governance reduces the firm's market value. In the context of developed and developing countries, studies found mixed results examining the relationship between investor base and firm's market value. And the mixed results are caused by differences in regional and institutional characteristics. The adoption of our implied cost of equity capital is motivated by studies. Moving on to that, studies have been elaborated on cost to found that better corporate governance practices increases the firm's market value to expected cash flows. But subsequent studies found that it is not expected cash flows, but reduced agency cost and reduced information asymmetry. So from the literature, it is clear that better corporate governance practices increases the firm's market value through reduced expected returns, and reduced expected return is the outcome of reduced agency cost and information asymmetry. The adoption of our implied cost of equity capital approach is motivated by the identification of Lee et al. 2010 and Palm et al. 2011. Lee et al. 2010 states that studies found new evidence of risk and return that is more consistent with the theoretical traditions of the literature. Palm et al. 2011 found that cost of equity reacts more accurately to the year-on-year changes in the corporate governance environment without being affected by the exogenous factors that affect the firm's future profitability and growth. As I already stated, implied cost of equity capital is the cost of capital that is applied in the current market value of equity and future earnings forecast. So in order to compute the implied models, we need earnings forecast for sell-side analysts. In the context of Indian firms, the earnings forecast for sell-side analysts is limited to a small subset of firms. In this scenario, we adopt a model-based earnings forecast technique, earnings persistence model developed by Lee and Mohan in 2014, following the implementation of Baid in 2005. We use these earnings forecasts to compute the implied models under price earnings growth model, Eastern 2004 model, and Haldar and Jyoti North 2005 model. We consider only these three models because these three models require only 2 period earnings forecast, while the other models like Gavada 2001, Clausen Thomas 2001 require earnings forecast for an extended period. So moving on to the hypothesis. In the context of Indian firms, we expect that a dispersed ownership structure reduces the incentive of small owners to monitor the managers, and that increases the agency conflicts. Increased agency conflicts increases the expected return. So we expect a positive relationship between investor base and implied cost of equity capital. Investor base variable in our analysis is basically refers to the number of shareholders above and below what is implied in the firm's characteristics. We have an optimum number of shareholders model developed by Haldar and 2013. Basically, the residual of this particular model is a variable of interest investor base in the analysis. We examine this relationship in the context of Indian firms because there has been a significant growth in the number of retail investors during the last couple of years. So this will generate substantial interest among the market participants in knowing how this affects the firm's market value. Moving on to the data, we downloaded data from CMI Globus, Bloomberg, and database on Indian economy RBI. The unit of analysis was studying listed firms in India with earnings data available for the last 15 years from 2006 to 2020. We downloaded data for 1,351 firms. We excluded financial firms because high leverage indicates financial distress. The period considered for estimating the forecasted values of earnings is 2006 to 2020, and in our empirical analysis, we consider data from 2018 to 2020. So before the empirical analysis, where we examine the effect of investor base on implied cost of equity capital, we first estimate the forecasted values of earnings, and we use these forecasted values of earnings to compute the implied models under price earnings growth model, Eastern model, and Haldar. Moving on to the models used in the study. First is the earnings persistence model developed by Lee and Mohan in 2014. The model is expressed as future earnings in terms of current earnings, positive and negative earnings, and its fraction term. We follow the implementation of Baid in 2012. According to their methodology, if year T is 2018, the coefficients to estimate the forecast earnings T plus 1 is estimated using a pooled regression over 2007 to 2016. Similarly, the coefficient projections to estimate the forecasted earnings equals to is estimated using a full regression over 2006 to 2020. So by adopting this methodology, we ensure that our forecasted values of earnings are strictly from the sample. Moving on to the implied cost of equity capital models. First is the price earnings growth model. The model is expressed as price in terms of 1 period and 2 period earnings forecast. This is the lighter version of Eastern Class of model, which assumes no dividend. Next is Eastern Class of model. The model is expressed as price in terms of 1 period earnings forecast, 1 period and 2 period earnings forecast, and dividend per share. So this is a generalized version of price earnings growth model, which allows for dividend growth. Next is Oriental model. The model is expressed as price in terms of 1 period earnings forecast and short-term growth rate. G in this model is basically a short-term growth rate. Studies use different approaches like they said G as the average of short-term and long-term growth rate. In our study, our forecast period is limited to 2 years, so we said G as short-term growth rate. Gamma minus 1 in the equation, this equation is basically risk-free rate minus 3%, which is a constant rate for inflation. Then the dividend in all the implied models are assumed to be constant, and this is following Haldar until 2011 and Lee and Mohammed 2014. Moving on to the implied cost of equity capital estimates in the context of Indian firms, we have 3 implied cost of equity capital models and an equal weighted average of all the 3 models in our empirical analysis as the dependent variable. Then panel B reports the pairwise correlation between implied cost of equity capital estimates. We can see that all the implied models are highly correlated with each other. Moving on to the variables used in the multivariate analysis, the variables are log of shareholders, firm age, size, WQ, market capitalization, return on equity, book to market ratio, beta, price, leverage, stock return, volatility, cash ratio, liquidity, and asset turnover ratios, and investor stock agency costs. Moving on to the descriptive statistics of the variables used. Now skipping this slide and moving on to the multivariate models and results of our study. So first is the optimum number of shareholders model developed by Poonam and Rashid 2007. So this model basically predicts the optimum number of shareholders of a firm. The residual of this particular model is a variable of interest, investor base in the subsequent analysis. So investor base actually means the number of shareholders above and below what is implied in the firm's characteristics. A positive residual means large shareholder investor base, and a negative residual means small investor base. The dependent variable of the model is log of shareholders. The explanatory variables are firm age and volatility control for the total risk of the firm, return on equity and positive stock return control for the effect of recent performance on number of shareholders, market capitalization capital size, book to market ratio controls for the firm type, 1 divided by price and the liquidity are the measures of liquidity based on transaction cost and volume. Asset turnover ratio is an investor stock agency cost. We first estimated the model using old oilers, time dummies and industry dummies. Then we also estimated the model using panel fixed effects with time dummies. The residual from the pooled oilers will be our investor base variable in the subsequent examination using pooled oilers, and the residual from the panel fixed effect model will be our investor base variable in the subsequent examination using panel fixed effects. Moving on to the empirical results where we examine the effect of investor base on implied cost of equity capital. So investor base variable here is basically the residual from the previous model. We have 3 implied cost of equity capital models as our dependent variable. And we also included an equal weighted average of all the 3 models as one of the dependent variable. We also included market-based measure of book value problem skill as a dependent variable in one of the regression, and the results are reported in column 5. So when the expected rate of return increases, the firm's market value increases. So whatever is positively related to the implied cost of equity capital should be negatively related to the firm's market value. The control variables included in this analysis are leverage, beta, size, book to market ratio, asset turnover ratio, and cash ratio, and these are taken from the literature. So the model is estimated using pooled oilers with time dummies and industry dummies. Industry dummies capture on the time invariant norms of heterogeneity, and proper standardness are recorded in parentheses. So from this analysis, we can see that investor base is positively related to the measure of expected returns, that is implied cost of equity capital. So a positive, so that actually means when the ownership is dispersed among large number of investors, it increases the expected returns. Increased expected returns reduces the firm's market value. Moving on to the same results using panel fixed effects, we have estimated the model with panel fixed effects with time dummies and started at firm level. Here also we can see that investor base is positively related to the measure of expected returns, that is implied cost of equity capital. Moving on to the additional subsample analysis performed in this study. First, we performed an analysis considering only the positive residuals of the optimum number of shareholders and found quantitatively similar results. Second, we segregated the firms with persistent and non-persistent investor base. And there was in this analysis also we found qualitatively similar results. Then we performed an analysis using the lag independent variable, that is investor base variable. Because our panel data is limited to 3 years, we cannot employ a GMO or similar technique to address the problem of simultaneity. So we used lag independent variable and performed an analysis and found that the results are qualitatively similar. Moving on to the findings and implications of our study. We found that the investor base is positively related to the measure of expected return, that is equity cost of area. The positive relationship is caused by the increased agency conflict associated with the dispersed ownership structure. When the ownership is dispersed among large number of small investors, it reduces the incentive of small owners to monitor plans, and that increases the expected returns. Increased expected returns reduces the firm's market value. So our results are qualitatively similar in terms of controlling for unobserved representative. We have seen the results of plan fixed effects. The implications of our study are the findings will be of immense help to managers in ensuring better financing decisions and for market participants in making investment decisions. Thank you.
Can you go to slide number 8?
Slide number 8. Slide number 8. Yes.
Yeah. That's okay. Okay. So what is the difference between beta 1 and beta 3? Because they look similar. Can you hear me?
So beta 1 is the cost equation here.
Yeah.
Okay. So beta 1 is actually the coefficient of the indicator variable for past year negative earnings, and beta 3 is the interaction variable of negative earnings and earnings, current year earnings. So that is actually beta 3 is the interaction variable.
Okay. Okay. Yeah. So you are also using RB variable.
Yes, sir. We are also
That's
using
right.
interaction variable.
That's right.
Okay.
No, thank you. Just wanted clarification.
So that is the presentation.
Have any observations you can make on the paper, or we can open the floor to the
So I will discuss a couple of points. Can you go ahead?
Yes, sure.
Diagnose this, sir, or you want the
Yeah.
Thank you.
So, good paper overall. Like you have almost brought up everything that is concerning the cost of equity, ex-ante cost of equity indicator. You have used 3 models, EG, EP, and OJ models, and all the models are in nutshell they are giving the same results, and even the variables are like more correlated. That. So one thing which I found very good about the whole your regression model is you have used asset turnover ratio, which is something I usually don't see in some of the models, and that's something very remarkable in you. Because when you use asset turnover as one of the variables, what happens? It's also factoring how market participants are reacting to the company's performance, which is so could be agency cost, which could be investor base or anything. But asset turnover is a very good indicator. So I was happy to see this as one of the variables. And your findings suggest that firms with an increased investor base will have increased cost of and reduced firm, which is obvious because like the more diversified it is, and that's a good finding. Now coming back to equation 6 in your paper, so I have seen that there was a mistake in the original paper submitted by you, which you corrected. So I want to show you that. See this. So.
Stand over there.
Yeah. So if you can say this, Just see here.
Yes, sir.
So, like the interaction variable beta 6 and beta 7 are interacting, but whereas you connected it with this one,
No, sir.
and they are
This is a
something.
different way. This is a different equation. But this equation is used to examine the effect of investment. So, in the first paper, I have said that there is a mistake. In the second submission, I actually have made an assumption that there is a mistake, sir. We have renamed the variable excess investment base to investment base. So that is actually a mistake.
That's fine. And the other thing is beta 5 is missing in this. Okay. So where is beta 5?
Okay, so yes, sir, that is actually a mistake. We actually counted it. We submitted the paper.
So fine, perfect, yeah, right? So yeah. Good. Like the model that you use is looks to be robust because you have included investor base, which is one of the important leverage is very important
Yes, sir, to capture the financial distress.
About beta, I have one question. Put that you're standing side by side. So where from do you take beta?
Sir, it is the market-based value. I have taken it from CMI course.
Okay. So do you have any idea how the duration they capture for beta? For example, I can regress 1 year stock return vis-a-vis Nifty return, and then I have my beta. I can do it for 5 years.
So it is year-wise beta, sir. So it's for 1 year.
Okay, but how stable that will be? Because your like the period that you have taken is, I think, quite longer duration you are taking for the data in the sense.
Sir, that is for the estimation of forecasted values of rates. This is for the empirical examination. So in this model, beta actually captures the volatility. That is of the model. So when beta is higher, that should increase the infinite cost of beta. So the expected value increases when the volatility increases.
Obviously, yeah.
So,
okay. So otherwise, this model will be you are also factoring size and book to market, which is price to book or
book to market.
So,
Growth firms will have higher expected returns. So book to market ratio is positive.
Yeah.
Expected returns.
Another findings of yours, which is like somewhat surprising to me, is what you are saying is this lies between 23 ICOE lies between 26 to 31%.
Yes,
are you sure about it? Because my sense is, if this is the return, then no one should put money in any market in the world and come back to India and make so much huge amount of gain.
Right, so this is the value actually, right, with the market value, and with the earnings focus that we have focused using the model.
Okay, so could you throw some light in the sense that like your firms are representative of the larger broader market or like mid cap?
No, sir, this is a representative of the broader market. We have taken firms with the earnings data available, so it's a broader.
So this is of course I cannot question the value that you have got, but this looks to be too high a value for me. So if you get cost of equity so high, I doubt whether someone will whether it will not exploit this anyway. So and again, you mentioned in some of your write-ups that large firms have larger investor base, but not in case of India, which is conflicting in some other places. But any reason for
writing? In the knowledge of development and studies found some results actually. Okay. So some studies found positive relationship and some studies found negative relationship. So the positive relationship is caused by when the ownership is dispersed among large number of investors. The risk is shared among large investors. So the market value increases. But in the context of emerging markets, the evidence from China also suggests that when the ownership is dispersed among large number of investors, it reduces the incentive of small owners to own into the business. So that actually increases the expected returns. So that is why we are showing a positive relationship with industries.
So in India, your conclusion is the same
as we have observed in the studies from Spain, MIT and so that's similar to our observations are similar to the So, but they have examined the relationship using the market-based measure of comparing topics. We have examined the relationship using expected returns. So we measure this is because studies found that the deviation in firm's market value is precisely captured in the expected returns. And implied cost of equity gathered cells is the measure of expected returns. So that is why we try to compute the implied cost of equity and examine the relationship on implied cost of equity.
So another finding of your report, which is significant, in the sense that you find that significantly higher cost of equity capital, And the difference between this box type which you have captured here is 240 basis points, which is significant.
Yes, sir.
2.4%.
Yes, sir.
And it is the reports are significant at 10%.
Reports, sir, most of them are the pooled oils is significant at 1%. The panel fixed effect is significant at 5% and 1% increase.
So it's significant at 5%.
5% in the panel fixed effects.
Yeah.
So the pooled oil is significant at 1%.
Good. So that way, yeah, that's way it captures you have stated mostly obviously, but some of the findings are little surprising. So maybe I don't know. This 26 to 31% is something that I will still say, right? So this is
Yes,
very high compared to any other market. But maybe you would like to look at it
Yes,
bit more time. But this one is very good, and the paper as the findings have come out well. And obviously, you have stated should have been stated. So thank you very much.
If there are any questions from the online or offline audience, we can take them. There are no questions. All right. In that situation, we will move to the next paper presentators. That is Jyoti, Dixit and Poonam Singh. They would be presenting on family ownership and value of takeover, evidence from media.
Good evening, everyone. This is Professor Jyoti Dixit. I'm an assistant professor in Lahija Business School and currently a research scholar from Delhi. My topic for today is investing in recovery, challenges and opportunities for Indians securities market. So my topic is family ownership and value of takeover, evidence from India. I just want to give a small introduction of the topic. Family firms account for a significant portion of the world's national economics. Ownership structure, this family ownership of the target firm has an impact on probability of acquisition. So just now, Jains has told that Indian economy is characterized by concentrated ownership. And in India, if we see, there are very big family firms, like for example, Tata's, Birlas. So these are very well-known firms, and the ownership is very high. Shareholding is very high with these promoters. Considerable debate on whether family ownership affects merger decisions or not. So some studies find that family ownership affects merger decisions positively, and some studies are of the opinion that there is negative association with family ownership and acquisition decision. So there are inconclusive results. So we investigate these issues. So why am I choosing Indian economy is high concentration of ownership by family members, weak takeover market. In India, the market of takeover is not very strong, and underdeveloped capital market. That is also a characteristic of Indian capital market, and weak governance structure. So this might be the reason why promoter stakeholding is usually very high in Indian economy. Further, India has undertaken widespread legal reforms to protect investors. So, by strengthening its governance structure that provides an exciting background for the study. So, what is the contribution is in terms of this is among the few papers that examine how shareholders view the impact of ownership by family members on firm value during takeover events. We investigate the relationship between family ownership and value creation during mergers that were at different level of family ownership. Like some studies define family ownership at 20%, some studies define family ownership at 50%. So we have divided ownership at the levels 20%, 40%, and 50%, so that we can see the effects in a linear way. The study juxtaposes two agency conflicts in the Indian takeover market. So Jains sir also mentioned about agency conflicts. So I just wanted to test that in Indian economy, which what type of agency conflict is prevailing in Indian market. So a small literature review, family ownership, impact on a probability of acquisition. So takeover is considered as a mixed gamble approach. So some studies show positive side of takeover, some studies show negative side of takeover. So advantages of takeovers might be in the form of job opportunities, diversification, intergenerational transfer of family firm. Like they want to transfer their business to family members. We can see the good example is the Kumari group. So how it is being passed on to generations. Reduction of portfolio risk. Family firms are usually not very well diversified. If they stay in one line, they stay in that line only, that production, that product only for many years to come. Disadvantages of family firm is acquisition to family firms is dilution concern. If they go for takeovers, the control might be in the hands of the party in front. So they lose control over the firm. Fear of losing power affect socio-emotional wealth, threaten the continuity of family business. So based on these mixed findings, our first hypothesis is family ownership has an impact on probability of acquisition. Then family firms and announcement period abnormal returns also we are covering in the study. So we are using again study methodology for our study. Mixed evidence on the effect of family ownership and announcement period abnormal return true. So like family firms outperform non-family firms around the announcement date, and the other studies state that the takeovers destroy value. Okay, so family owner, based on the finding of the literature, our second hypothesis is family ownership affects the stock market reaction to takeover announcements. So we have collected data from 2003, 2018-19. So for offer, initially our sample size was 1,324 firms. Out of that, 221 firms, which were repeated targets, were removed from our study. We have removed non-financial firms from our study, so that led to a sample of 734 target firms. And we have used non-matched sampling. So we have taken all NSE BSE listed firms. So that gave us a sample of 3,296 control firms. So in all, we have 4,030 firms in our data sets. So these are two variables, family ownership. So as I stated, we have defined family ownership at 20%, 40% and 51%. So that too is based on literature only. So in India, the ownership is highly concentrated. So what we have found in our study is 20% of maximum firms are there. Okay, so in Indian context, 51% will also prevail. Cash reserves, PB ratio, quota, debt equity, total assets. Offer premium, the ratio of difference between the offer price and share price 4 weeks before the public announcement. We have taken pre-offer stake and D values in millions too. So our dependent variable for probability, it is a binomial variable that takes value of 1. If the firm is an acquisition target, 0 otherwise. And we have also calculated cumulative abnormal return for our studies. So the formula for that is, it is the difference. We have taken Pharma French C-factor model in 1992. So alpha, market premium, SMD and HML are 3 factors. So cumulative abnormal return is the total of all abnormal returns. We have taken an estimation window of 90 days, minus 30 to minus 120. And we have calculated CAR for different period, that is +1 -1, +2 -2, and +5 -5 based on literature. For us, I had collected first equation, I know sir must have noticed that it might be there in this PPT too. But sir, the first one is it is not log of offer premium. I had corrected it, but the correct one is not here. It is cumulative abnormal return as my dependent variable. And the other independent variables are family ownership, PB ratio, ROTA, debt equity, deal size, offer premium. We found endogeneity in our data. So to account for endogeneity, we have used Heckman selection model. So premium is observed if the first equation is satisfied. So for that also we are taking different variables. So the above model is estimated by MLM, regression estimation using non-selection hazard, that is Heckman selection model. So descriptive statistics. So we can see that family ownership of 51%, the mean is 54%. So that stake is too high. We have calculated premium, car, cash, PV, ROTA. So correlation also, this is the correlation table. I am skipping this for time being because of time constraint. These are our models. So first three models, this is our main table that is accounting for cumulative abnormal return. So first three models are based on OLS regression. The dependent variable is cumulative abnormal return +1 -1, that is 3 days. And the remaining 4, 5th and 6th table are, we have received it from Heckman selection model, probability. So the table, the results state that at very low level of family ownership, car is positive. And at the high level of family ownership, car is negative. So in agency theory, there are two agency theories, type 1 and type 2 agency theory. So type 1 agency theory states that there is a agency conflicts arises between managers and stakeholders because managers try to gain personally through the firm. And agency conflict 2 states that it is a conflict between minority shareholder and majority shareholders. It is family in our case. So at high level of family ownership, agency conflict 2 prevails as per our study. And as we can see in model 4, 5, 6, the coefficients are significantly negative at all levels of family ownership. Okay, so target firms are not attractive, whatever be their family ownership, but in case they are acquired, the market returns are positive at very low levels of family ownership and not at high levels of family ownership. So here we have taken 30-day offer premium, which is the standard in industry, standard in publication. So I have done some few robustness tests. So table 4 is target announcement return regression, car +2 -2, car +5 -5. I have taken car for 5 days and 11 days too. So model 1, 2, 3 accounts for car 5 days and model 4, 5, 6 accounts for car 11 days. All are OLS regression, and we can see that our results are robust to the alternative definitions of car 2. Here also again we are taking 30-day offer premium. Then here we are taking additional probability. So we are testing the probability also at different levels. So I cannot see it here. So we have taken additional probability 2 at car 5 days and car 11 days. Slideshow. So car, we have taken additional probability at car 5 days and car 11 days too. And still for these definitions also our results are robust, except family 20% where the coefficient is turning negative. And for probability the results are same. We have also tested the additional OLS regression with car +1 -1, car +2 -2, car +3 +5 -5. With 15-day offer premium, and we can see our results are robust to these definitions. 15 days offer premium too. Additional OLS regression with car +1 with 40-day offer premium. So I have also tried with 40-day offer premium. So 30-day offer premium is standard in the literature. We have tried our results with 15 days offer premium and 40-day offer premium too. So the results are family ownership has a negative and significant effect on takeover probability of target firm at all levels of family ownership. With 20%, 40%, and 51%, lower levels of family ownership are associated with favorable announcement period and normal return, but it turns negative at higher level of family ownership. For our study, we have visualized all variables to 1% and 99%. We have lagged all independent variables with PA date. And thank you.
Can you just show your model specification?
Yes, sir.
Just slowly.
Yes, sir.
Yeah, here, over here. So I can see that mu2 is a standard normal distributed, but not mu1. Are you sure that this is a there is some spelling mistake or you have purposely done it?
I have taken it from literature, sir.
But how is it that the mu1 is not a standard normal, whereas mu2 is a and their correlation is the same? So that doesn't look possible. Maybe you need to look at it
I'll look at
then
it.
I will discuss the other things.
Yes.
Okay, fine. Correlations of covariance elements are there, so it's not possible. Yeah. So basically, your paper. The report and the paper has come out well, in the sense that what you have stated and spoken just now is obvious, which is what papers report, which is what some of the discussion paper we get to read about takeovers. It is a fact that how Indian family members behave and why there are issues related to takeovers. The good thing that you have done is you have taken a relatively very longer period of data, which is good. And you have mentioned that it is because steady data is not available for period prior to this.
Yes.
So that way it's fine. 16 years is pretty okay. The good finding is that higher the family ownership, it's no attraction. So what you are basically trying to say that the people have already destroyed, so no one is willing to take that for. Value has already been destroyed. So one more finding of your paper, which is you're talking about higher cash holdings. So have you walked further in this, because higher cash holdings also implied, and which is what you are saying, is the risk aversion the family owned businesses, because they want to be certain in terms of having enough cushion to tide any crisis, to manage any crisis. So like how was this variable? It's how significant was this variable?
This was significant. I have taken cash and cash equivalent at the end of the year. And it was present positive and significant in all the models, as you can see. So basically, cash holding of family firms has a positive impact on takeover performance.
Obviously, because anyone who is acquiring is not ready cash.
Ready cash, so they go.
Was it the sole reason for acquiring those firms? No,
it was not the sole reason to acquire those funds. So we can see ROTA, we can see other variables too. So I didn't discuss because of time constraint, but we could see many variables which were the reason, which was significant in my models.
Okay. You have talked about profit regression, but I didn't see the model.
Sir, when we acquire equipment, so it automatically takes care of profit regression.
Oh, okay.
So by default, it takes profit regression.
Oh. So fine. So what you have stated largely is in line with the empirical findings, and the literature review that you have done is also good. So your paper doesn't leave any scope for me to critically evaluate, which is what you are afraid of. But when you state the obvious, which is like you said what is there, so nothing much to say. Let me see. So you are also saying family-owned targets are not preferred targets for whatever level of ownership. So that also is a good finding. But 20%, 40%, 51%. So 20% is where you have found that there are some juices left in terms of takeover, and those things are reflected in the value.
Because 20% is too low stake in Indian context.
Right.
So they don't have any control, like they cannot affect the decision too much.
Right.
50% control is very high. So for mean of 51% was 54% for us. So that itself is a higher control, higher stake in family, where they can affect strategic decisions in the family.
So, good overall, like I'm happy with the report. This is the way you have presented, and things, everything is covered. Nothing much to critically analyze. Leave it to the chair to say it.
Yes, maybe towards the end I will make my remarks. But as of now, if there are any questions from the audience or those who are online, are there any questions? So let us now move to the next paper, which is Institutional Investors, a reluctant activist or enthusiastic contributor. May I invite the paper presentators, Irfan Rashid and Dr. Arunima Haldar. Are they presenting online?
I don't think, because one of the authors tried to reach out to me, so I'm sure he must be present.
Is Irfan Rashid around? Is he?
These are the Kashmir people, Jammu and Kashmir.
That's right. He's from NIT Srinagar. Okay. Okay, so the third paper will be presented tomorrow. All right, so then that means there are only. So, Jainendra, now we have some time in case you want to ask.
May I intervene?
Yeah,
Okay, Arunima is presenting. All right.
Yeah. Okay, we have already informed because Irfan's flight got cancelled because of snowfall. So we both will be presenting in the online mode today.
Certainly, sure, Arunima.
Thanks a lot. Can you please allow Irfan also to join as a presenter?
He's joined as a presenter.
Okay. Irfan, can you please start?
Yes, please, Arunima.
Yeah, Mr. Irfan, please unmute yourself. Mr. Irfan, please.
Good evening, everyone. Yeah, I have unmuted myself. Am I audible?
Yes, you are clearly audible.
Yeah. My name is Irfan Rashid Ganie. I'm a doctoral candidate at NIT Srinagar. This paper is co-authored by my guides, Dr. Arunima Haldar from SPJIMR, Mumbai, and Dr. Tahir Ahmad Wani from NIT Srinagar. This is our presentation outline for today. First, we'll be discussing motivation for this study, then introduction, research gap and questions. Research design will be discussed by Professor Arunima Haldar, and then findings, conclusion, and implication will be discussed by myself. As all of you must be aware about this incident related to the renowned banker of the Indian banking industry, Mr. Deepak Parekh, his reappointment to the HDFC board was opposed by many institutional investors, especially foreign institutional investors, citing issues related to his low attendance in previous board meetings and his appointment to multiple boards of the company, which amounting to his board busyness. This resolution was still passed in the with the help of other shareholders, but
Presenting full screen. Would it be possible for you?
Sorry.
Can you make can you present it in full screen form? Or maybe it's not available.
I think if you use Shift plus F5, it should do.
Or
maybe
from here we can.
Yeah. No issue.
problem. Please carry on.
Carry on.
Okay. Given the size of the company involved and the brand name of HDFC, this is one of the landmark incidents in India related to institutional investors' activism and corporate governance landscape. Previously, institutional investors' function was confined into their investments, and they mostly worked as a passive owners in the business activities of their firms they have invested in. And over the period of 2 decades, they are now involved in the day-to-day operations of their investee companies. Recent studies suggest that institutional investors often use their voice through proxy advisory voting and behind-the-scene engagement with the management of the companies they invested in. Proxy advisory firms are basically firms which help institutional investors to take informed decisions.
Irfan, your slides are not moving. You want me to share the slides?
Yeah, ma'am, if you can, please.
Okay, can you please intervene for a minute? I can try it out.
Yeah, I will stop sharing.
Yeah, just a minute. I will just say. Can everybody see this?
Yes.
Screen? Okay, thanks a lot. Irfan, you may continue.
Yeah, okay. As I was talking about proxy advisory firms, they help institutional investors to take informed decisions regarding the resolutions, proposals, and other firm decisions which are critical to their investment interests in the investee companies. Proxy advisory firms in India came into existence around 2010-2011 financial year, simultaneously because of the regulation that was brought up by SEBI regarding the mandatory publishing of the proxy advisory, voting policies and voting pattern of the mutual fund companies on their respective websites. Recently also, SEBI came up with a regulation which made it mandatory for mutual funds to vote in their respective investee companies. Also, we have seen a stewardship code of 2019, which made it clear for the mutual funds as well as other companies who are part of institutional investors, who come as an institutional investors, to work as stewards of the money of the people, as well as help to improve the governance mechanism of their investee companies. Now, coming back to this, there is still remains a dichotomy regarding whether institutional investors, work as an enthusiastic contributors or elected activists in India. Therefore, we have identified a gap from the research literature review, but there still remains, less evidence of institutional investors' role in the corporate governance practices in general, and same is true in the Indian context. Therefore, we aim to study and fill this gap by exploring the role of institutional investors to influence the corporate governance practices in Indian listed companies. And accordingly, we have formulated the 4 research questions for this study. First is, because we are taking proxy advisories also into consideration, so we will be seeing how powerful are proxy advisory firms in order to translate their voting advices into action of their clients, which is basically mutual funds. So we'll be using mutual funds as a proxy for institutional investors in this study. Second question is, what are the resolutions where mutual funds differ from their advisory recommendations? Third question is, how do institutional investors voting affect the final corporate decision? And fourth question is, how do institutional investors engage to influence the corporate governance mechanism of the investee companies? And from there, Professor Arunima will be discussing the research design of the study.
Thank you, Irfan. So when we talk about the research design of the study, as it is an exploratory study, because we find very few studies which have been done in this context, moreover in emerging markets such as India. So we took the sample of top 10 mutual fund based on their asset under management. If we look at the mutual fund AMC, we could find there are 42 AMC, out of which top 10 almost cover close to 50% of the asset under management in this industry. So these were the mutual funds which we have chosen as our sample. The source of our data was mutual fund websites where we could get their voting data in their investing company in a quarterly manner. So we collected data for 5 years. We looked at AMFI website. We looked at proxy advisory firms website also to get some data and get how did they impact and where are they invest, what were their voting patterns. Apart from that, we have also gone ahead and done some case studies on Indian companies where institutional investors had objected or had played an important role in improving the governance of the particular company. So if we look at the time period, we were, as we have said, that we were looking at the time period of 1617 to 2021. So these were our sample mutual funds, which are all the major mutual funds, which account for 52% of the total AUM as we have discussed. And the total rupee value is close to $20 trillion. So when we talk about the research design, our data, as we have said, was from proxy advisory. What was their recommendation? Was it for the resolution, against, or they were neutral? Similarly, did the mutual fund adhere to the proxy advisors or they had their own voting patterns? And finally, how did the voting or these institutional investors say, did they impact the final voting outcome in an listed company or not? Coming to the variables, we would look at the voting patterns, and the methodology is a qualitative exploratory study wherein we have collected data from various sources, various secondary sources. First, as we have discussed, from mutual fund websites, from proxy advisory websites, from AMFI websites, as well as for the case analysis of Indian company, we looked at popular press, we looked at Twitter, we looked at social media, which are the major cases wherein it was really something worthwhile where institutional investor objected, and this brought even retail shareholders to look at the problems which are going on, be it related party transaction, a director getting reappointment. So these are some cases, even if the company didn't adhere to, or because of the final say, company could take another decisions. But what happened? What was that the retail shareholders also could understand that there are some corporate governance glitches which are happening in the company. So, Irfan, you may continue from findings. Thank you.
Thank you, ma'am. When we come to findings, first research question, please, ma'am, can you please? Yeah. Are proxy advisory firms powerful enough to translate their advice into action by their clients? Before answering this question, I would like to mention 3 proxy advisory firms that are actually right now working the proxy advisory in India. First is Institutional Investors Advisory Services, IIAS. Second is SES, Stakeholders Empowerment Services, and third one is Inbound Proxy Services. Out of all these 3, Institutional Investor Advisory Services controls the major market share, and they have the maximum coverage of the resolutions that are brought up in the Indian listed companies. And we have also sourced data from this particular advisory firm. The reason being they have the maximum coverage, plus they are also active on different social platforms. They conduct webinars. They provide industry analytics regarding new reforms. They provide expert analysis, and their data is also publicly available, as was not case in the other 2 firms. So first question, whether proxy advisory firms are able to influence the decisions of the institutional investors. If you see from the graph, the chart depicts the proportionate of resolutions which were voted differently by institutional investors as against the voting recommendations provided by the proxy advisory firms. As evident, more than 70% of recommendations from proxy advisory firms are followed by the institutional investors. We can say that voting of institutional investors is highly influenced by proxy advisory recommendations based on the data. Yeah, ma'am, next. So second question is related to how institutional investors impact the voting outcome of the resolutions they vote in. So as is seen in this graph, firstly, when it comes to supporting the resolutions, most of the resolutions are actually in favor of the institutional investors. Whenever they support any kind of resolution, that is actually passed as per their vote. But when it comes to opposing the resolutions, the chart depicts actually the opposition of resolutions. So when it comes to those institutional investors, they have not been quite successful to change the outcome of the resolutions. If you see, it's evident from the data, the percentage of resolutions basically which were actually opposed by institutional investors, but they were actually accepted in the final outcome are more than 80%. So based on this data, we can say that when it comes to opposition of the resolutions, institutional investors have not been quite successful. But if you see the graph, if you see this bar chart, it shows that from 2017 to 2021, their influence has increased slightly. Yeah, next, yeah. So this particular slide talks about the research question third, which is what are the different types of resolutions that are generally brought into the company meetings, and what are the resolutions where institutional investors have shown maximum opposition. Most of the resolutions that are brought actually fall in the director appointment category, followed by audit, remuneration and compensation, and so forth. And resolutions which are majorly opposed, which have got opposition from institutional investors, are director appointments, followed by related party transactions, then remuneration and compensation, and ESOPs. These are the four major resolutions which have been opposed as per the data. Yeah, ma'am. Please, next. Then the last research question, instances where investor engaged to influence the corporate governance mechanism of the investee companies. Before giving the analysis of these four cases, I would like to mention that for studying this research question, we choose four cases for our study, mainly for two reasons. First, they are well-known cases from the various industries where larger minority interest was safeguarded by institutional investors. Second, these particular incidents had a big influence on the governance of the companies in the sample, which basically we will discuss in detail. Furthermore, these incidents basically drew a lot of attention from the media and other public outlets, drawing the attention of regulatory agencies and other stakeholders. When we talk about the first case of HDFC Bank, in this case, a special resolution was brought up by HDFC Bank to prolong the directorship of Mr. Deepak Parekh. It was opposed by major institutional investors, especially foreign institutional investors, who were advised by different proxy advisories, that too from US also, citing the issue of the director performance of Mr. Parekh. One was that he has not been regular in the meetings of the past, board meetings. Second, his busyness in terms of being appointed to multiple boards. Even one of the company, which is an institutional company, a proxy advisory firm in US, named as Institutional Shareholder Services, they were not happy with the board performance under Deepak Parekh's membership. This particular resolution was opposed by around 23% of shareholders of HDFC Bank. And at the end, even though there were quarter of the shareholders opposing it, this was passed. But it actually paved way for the one of the landmark incidents that happened in the banking industry. Second case is related to Fortis Healthcare. In this case, the family, this firm actually had some governance issue related to handling the ongoing bids of takeover of Fortis Healthcare. There are mainly three bids, which first was from Manipal Hospital, second was from IHH hospitals, and third bid was from Munjal and Burman. In this case, the company approved the bid of Munjal and Burman, who are not having any background of industry of healthcare, and they have actually disapproved the bids from Manipal and IHH Healthcare. And in this case, what happened? Major shareholders, along with institutional investors, requested an extraordinary general meeting to remove certain board of directors from Fortis board, and they were successful in doing so. And many other board members resigned as well. At the end, after the change in the board, this bid, which was from IHH Healthcare, it was approved, and they actually took the stake in the Fortis Healthcare. Third case is related to Eicher Motors. This happened last year when Mr. Siddharth Lal's reappointment as MD was opposed by institutional investors. That was basically because of the pay hike that was given to him. It was about 10%. The institutional investors as well as proxy advisory firms highlighted that in the COVID pandemic, the sales were the sales degrown for the company, and overall the profits were not even more than 10%. That was.
Sorry to interrupt. You have to conclude right now. It's already over past time.
Irfan, we request you to conclude your presentation within next 2 minutes. Would that be okay? I mean, this is something descriptive. We all have gone through. Maybe move to your concluding slides.
Oh, okay, ma'am. I will do that. So these are the major cases actually which shaped the corporate governance landscape in India with relation to institutional investors' activism. Ma'am, can you please go to next one? So in conclusion, according to findings, institutional investors in India employ proxy voting to sway resolution in their favor, particularly when they think the resolutions are determinant to their interests in the company. However, because of the concentration of promoter holdings in India, their voting strength has not been strong enough to affect the resolution results in general. Even though there are instances from cases where institutional investors have been successful to oppose the issues related to corporate governance and firm decisions. They have been successful, as we discussed in the cases, to force the companies either through proxy voting or activism to overturn such decisions. When it comes to implications, this paper has 3 types of implications. First, for policy, it will help the regulators to reduce the voting power of concentrated promoters who might otherwise give voting outcomes in their favor at the expense of minority shareholders. Other types of investors who, like for example, retail investors, should be made mandatory to vote in the resolution so that the balance of outcome will be aligned with their interests. And also, we propose better regulatory standards for proxy advisory companies so that there is a fair and partial, there is a fair and unbiased voting recommendations to institutional investors. For management, we propose that given the data which shows what are the resolutions where they have differences between management, promoters, and non-promoters, this will help them to understand the differences and actually narrow down the gap of the differences. When it comes to social implications, we propose that institutional investors play an essential role as a part of a society. They have more power than retail investors in safeguarding the interests, investment interests, as well as they have power to oppose those decisions which will not be vital for the environment in general. So with that, I conclude and thank you for your patience.
Okay, so Irfan and Arunima, I must congratulate and thank both of you for writing on something very relevant and timely. Because the world over, people are talking about ESG, environment, social, and governance. And this is in some way you have touched upon by writing on a very relevant topic. So before I proceed on the findings of your report, which is also very interesting, let me tell you one thing, that when you talk about institutional investors, you should really define what institutional investors you are talking about. So you have, throughout almost every places, you have talked about mutual funds, and you are using the term institutional investors. However, institutional investors will also include the other domestic financial institution, hedge funds, category 3 funds, category 2 funds, and most of other institutions. So yeah, when you write a report, you should specify as to what are your who are your subjects about whom you are talking. So you must have talked about mutual funds, so you could have said something like this. And the best part is like about your report is your report comes out like a normal newspaper reports where you get to know about the historical background, which is what you talked about in the IIS or the proxy advisory firm. So you have given a very good brief background about all these three firms in India. And also the sample that you have collected, I think there is a very good sample because overall they hold over 50% of the mutual fund assets. So that way, even if you have selected 10 funds, but in terms of the asset and mandate, they occupy over 50% of it. I was surprised to see some of the top-notch mutual funds missing from your report, but I will not question you because I understand that the criteria, the filter that you use probably identified, and that gives me some pause discomfort that why some of these top-notch mutual funds are not part of your study. So maybe we need to look at those things. So some of the prominent mutual funds are missing in your sample. Coming back to the presentation part of your report, which you have submitted to us and what you have presented, I understand that there is time gap and you get to revise it and rewrite it, so that's okay. But when you present it to us, the table 1 figures are missing, the unit figures are missing. So I have to guess whether you are talking thousands of crores or it's a million. So be careful whenever you write report that you have to assign the units. And with table 2, the percentage figures are would make it more comparable. So if you could have added percentages, then probably I would have been better able to appreciate that, okay, this much percentage is the share of this fund, or overall this much is being voted by the mutual funds as per the recommendation of the advisory service. So coming back to your recommendations, so what you are saying is the overall recommendation of institutional investor advisory services is better accepted by public sector mutual fund, which is what you have written, but you have not said, because I see that in terms of acceptance of recommendation, the public sector funds are better, much better, and the private sectors are like questioning, which is what they are supposed to be doing in their offices. So, which is what they are doing. So, and the next one is. So another findings of yours, which is very remarkable, is the average percentage of voting against recommendations has gone down over the years. So what looks like to me is the funds or the institutions are deeply going into the recommendation of their proxy advisory firm, and then they are acting on that. And another thing which is, of course, which is obvious and which is what you have brought out is mutual funds entirely follow the recommendation which are in favor of the resolution. But you have not stated why it is so. And the answer is obvious, which you should have stated. So, and so your tables are talking about the situation of minority shareholders in India because they cannot do business because like we are still in the starting period of the revolution which has gripped the market. But it's only a matter of time. You have given very good examples of the last slide where you talked about HDFC, Fortis, and the Jainendra group where things are changing. So hopefully with this revolution picking up in a country like India, things will change. Of course, they have not been able to influence to the extent that they should, but hopefully things will change. So mutual funds in India employ proxy voting to sway resolution results in their favor, particularly when they think that resolutions are detrimental to their interest in the company, which is what you are stating. And so, what is the policy implication? So, put that there is policy implication that there are needs to empower the minority shareholders, needs to look into the ways in which votings are being done, and also think to actually one more thing could have been that if you could have brought some foreign examples into India, like for example, in your the concluding slides, you have shown that areas where there have been number of votes over the director appointment or balance sheets and things like that. So globally also, if you guys could have presented similar things, what happens in the Western market, probably that could have brought out the whole situation clearer. And I understand that investors to raise their voices directly or indirectly, and which is what you have said. So thank you for this paper, and I understand that this is a very good topic selected, and I can all wish that it gets published somewhere, because the findings have ramification both for the policymaker as well as for the investors of the mutual fund. So thank you very much, and thank you.
Thanks a lot for your comments, useful comments. They're quite useful and it would help Irfan because this is his first paper in his life. And I was so intrigued seeing, for example, Mr. Ahmad Tandon daily posting on Twitter about one or the other company, some of the resolutions. So that was something which we really felt to work on this paper. So thanks a lot for the pertinent comments. We would surely work on it. And further, we are working on taking more interviews of regulators, academicians, and these institutional investors proxy advisory firm so that we can strengthen this paper before submitting it to a finance journal. Thanks a lot.
Thank you so much.
Thank you.
Good evening to all of you. First of all, I congratulate all the authors on the wonderful presentations which they have made in the evening. I am a career teacher, and as a teacher, when I am listening to any research conferences or reading a research paper, I have a simple criteria. The criteria is, would I be able to take this research work to my classroom? And I'm happy to state that all the three papers which are presented in the session today are so useful to an academician teaching courses in the area of corporate finance, portfolio management, mergers and acquisitions, as well as to the policymakers, to the relevant stream of practitioners, to the corporates, to the investors, fund managers, etc. Talking about the first paper, wherein they have discussed how the investor base affect the ex-ante cost of equity capital. Very interesting paper that was, and where would I place that paper? I'm teaching a course in corporate finance. I do see that on day one, when I'm talking about the positive relationship between risk and return, and how the agency cost leads to higher risk and will turn out to be leading to higher rate of return, my students are able to now nod and they are able to relate to it, and that is the success of your paper. The paper can subsequently be presented at a little higher level when they are talking about, let's say, doing a course on strategic corporate finance or financing decision. It is such a good fit. And I apologize as a teacher. These are going to be my reactions to your work. The second paper, which was talking about how the family ownership affects the mergers decision. Again, a very interesting paper. I was hooked on to the observation where you talked about how takeover of family ownership reduces the portfolio risk. I was kind of relating in my mind to a topic which was discussed earlier on passive versus active investing. I hope you all were heard the discussions over there where they were talking about increased interest in indexing, increased index in smart beta funds. And I was wondering that one of the variables for creating smart beta fund could be the ownership, family ownership. And probably that could be a topic which one of my students can take up for the purpose of their dissertation. So that again led way to a lot of exploration which can be done. Lastly, the third topic, very relevant, very timely. I agree with Mr. Shandilya, probably should have been named a little differently because throughout you talked about mutual funds. But then, post renaming it as mutual funds investors, and if you replace institutional investors with mutual funds, it gives us further scope it gives you scope for further extension. Maybe you can cover broad industry at a broader level and can also talk about other kinds of institutional investors, as Mr. Shandilya was mentioning. So that work especially gives a lot of work for further expansion. Very interesting observations were made, and I saw everybody was glued to that slide where you were talking about those episodes, how were the reactions of mutual funds during the process. So again, I congratulate all the three teams for these interesting presentations. I do have some few technical observations here and there. Maybe I would connect with the authors separately. Should not hold you all up for that at this hour of the day. So thank you very much. We can now close the session. Oh, there's something more.
No. Good evening, everyone. It has been such an honor to be a part of this wonderful event. On behalf of SEBI and NISM, I would like to extend my heartfelt gratitude to our esteemed paper presenters, chairs, and discussants. I would also like to extend my sincere thanks to all the attendees and participants, both online and offline, for making the time to be with us and helping us make this event a grand success. Now, I would like to request Dr. Dixit and Dr. Jainendra to present a token of appreciation to our Honorable Chair, Rachana Baid, and Discussant, Jainendra Shandilya. So this marks the end of day 1 of 3rd SEBI NISM Research Conference. Thank you all once again for being with us today.